Now for our Did You Know segment. As I mentioned, I read a statistic this week that I thought was particularly interesting, and it inspired me to revisit this. We have talked about this on past episodes, but a refresher is totally cool by me. And also, guidelines and things change. At present, nothing's changed since the last time I reported out on this, but here is the statistic that I read this past week. Currently, 36% of the U.S. workforce is in what's called gig economy. So gig economy, things like driving for Uber, really, and that kind of encompasses self-employment. So since COVID, there was a shift. There were a number of people who started to question their routine jobs that they were in, and they've now sought self-employment, creating their own businesses, working in a gig capacity where, it's project-based and they get paid directly for the services that they specialize in. I myself, beyond being a mortgage professional, I'm a musician. I am part of this in some capacity. I perform at bars and restaurants. I perform at private clubs. I perform at public clubs, private parties, things like that. That is part of the gig economy, and that's just one example. But that can apply to individuals who are, like my wife, a graphic designer who does graphic design work on the side, even though she's a teacher as well. There are, take your pick of any other types of pursuits that are considered gig. So let's talk about what does that look like if you're trying to apply for a mortgage, if you're in this classification, which is self-employed. So starting out, overall, conventional loans and FHA, 2 years of self-employed history are required. And that's kind of your standard operating procedure. Now, that being said, when you have the 2 years of history, that's the minimum. If you've been working for 5 years or more self-employed, Fannie Mae and Freddie Mac, those are the two government-sponsored entities that provide the guidelines for conventional loan financing, do permit only 1 year of history to be documented for purposes of qualification income and reviewing your finances. So there's a little bit of a benefit if you've been self-employed for a longer period of time, particularly 5 years. That we rely on the automated underwriting system that we leverage when we are reviewing loans for our borrowers and for our clients. And if the automated underwriting system says this loan is eligible for 1 year of tax returns or 1 year of verification of self-employment history because they've already documented that they've been self-employed for 5 years, that's something that's accomplished by a letter from the CPA that prepares the taxes, and we have different iterations of verifying that. So 1 year is possible. There's some benefits to that. So if we look at the 2 years, and we'll start there, we look at 2 years of self-employed history, we are basing your qualified income on a calculation that's set forth by the loan guidelines we follow for conventional or FHA loans, and we take the net. So after expenses and write-offs from a business, we use the net income. There are a couple opportunities for us to add back in certain expenses, but by and large, we're using the net income. If you make $1 million as gross sales for your self-employed business and you write off $980,000 in expenses for the business, your qualifying income then is only $20,000. It doesn't matter what that top line number is. We go off of the net. So that's an important thing to understand. The other benefit now, where I'm talking about the 1 year of tax returns, is that we are only averaging out over 1 year. If you have to provide 2 years of tax returns, you've been self-employed for less than 5 years, and or you're applying for an FHA mortgage, we need to look at 2 years. We're going to do a 24-month average of your income over the 2 years. If we see that your income from year 1 to year 2 declines, we're going to actually just do a 12-month average of the most recent year, which is a lower income. This is because underwriting is risk assessment at its heart, at its core. So the onus is to have a conservative approach. And the conservative approach that's dictated by these guidelines is to look at the lowest number, and that's where they make their decision for lending. There are some other important things to understand, because if you are a business owner, there may be expenses that you write off. Things like, let's say a car, and you primarily use the car for business purposes. If you have a car loan or a lease, and that car is exclusively used for your business or majority used for your business, and your business is paying that, so out of your business account, you're paying your car loan. Well, when we're assessing your debt to income ratios, which is part of the qualification process, that is a liability that is already included in your expenses for your business. And if we're using the net, we don't need to hit your debt to income ratio with that expense a second time. If we document that the car is paid by the business, there's different ways we do that, but if we document it, well, we get to alleviate that liability from your qualification, which is pretty cool. That can be powerful and helpful. The other thing to consider are really the write-offs. So as I mentioned, any of those expenses, you get the tax benefit, which is great. And if you have a quality CPA, you're finding all of the write-offs possible. But there's a negative impact of that. And the negative impact is if you're trying to apply for a mortgage, we go based off of your net. So the more write-offs that you have, the less money you pay Uncle Sam, great, but the less income you have for qualification, not great. So those are a couple things to stay considerate of. There are some other alternative programs available if, let's say, applying for a conventional financing or FHA financing isn't really viable because of what I just mentioned, those write-offs. There are some loan programs that are considered, and they're called non-qualified mortgage programs. Non-QM is the short term for it. So I'll just call it non-QM. Those loan programs permit you to provide 12 months or 24 months worth of bank statements, and we would qualify you as a self-employed borrower based on the cash flow and expense ratio that gets applied to that cash flow based on the deposits coming in to your business bank account. So there are other ways to navigate your qualification if you are a self-employed borrower, which is pretty awesome. A couple implications for that are important to note. Conventional and FHA financing are likely going to be your best interest rate available as a self-employed borrower without consideration right now of credit score, things like that. Those are things that will impact your interest rate. I'm just saying apples with apples. Conventional FHA financing, likely a more advantageous interest rate compared to non-QM mortgages. Reason being, see the comment from earlier, underwriting is risk assessment. If you increase the risk, now the interest rate goes up because mortgages and the interest rates for mortgages are what we call risk-based priced. That's why if you have a 680 credit score, you're going to have a less advantageous interest rate than if you have a 780 credit score. So that reduces the risk, which then in turn winds up reducing your cost of financing, reducing your interest rate. Also, if you are a gig worker or self-employed and there's a seasonality to your business, that is something that we will likely require a little bit more, a higher level of documentation, I'll say. And those are things that we do. That's also why averages are used, because it can kind of mitigate and smooth out any of the seasonality, because then we're looking year over year. So those are a couple things to be considerate of. The main point to take away here is if you're a self-employed individual, if you own your own business or businesses, and or if you are a gig worker, do not assume that you're not going to be able to qualify for a mortgage. Reach out to me. Give me a call, shoot me an email, talk to a mortgage professional. There are ways to navigate that. And now, more than ever, there's more options for you. So if you're not prepared now, there are things you can do to prepare yourself. And those are good conversations. Those are conversations I particularly really enjoy, because we get to kind of put together the game plan. If here and now isn't viable, let's talk about how to get it to the point where it is viable. So that's the main point. Simply said, just because you're self-employed doesn't mean you can't qualify for a mortgage. Reach out, look into it. There's tons of resources also available to you online if you would like to look into any of this information any further.